in high school. I started in high school, and a lot of us have the same story, right? We started either mowing lawns or doing some type of work out there. And, I also went to college. I have a degree in economics. But I fell into that trap where I thought, as long as I knew, what mowers to have and what plants to plant, that my business would be successful. And, I worked hard. I come from, blue collar is definitely a kind of a compliment. I would almost say working class. Every answer to my family's, problems was go to work, right? You didn't feel good, you go to work. Whatever it was, you go to work. So I just figured if I worked hard, got up early, worked late, worked as many hours as you could, everything would be fine. And that worked for a while. And then when I tried to scale and grow my business, that didn't work. And I had gotten myself in a bit of a pickle to the point where in 2001, I was about $250,000 in debt and not including equipment payments. I was losing about $50,000 a year, and I had worked the business up to about $850,000 in revenue, and that's in 2001 dollars. Um, so I had borrowed $50,000 a year to about, the tune of $250,000 in debt, plus the lawnmowers, the skid steer payments. And I was really between a rock and a hard place. And I had watched a show on cable about people hiding out in Alaska. And I watched it was like in December. And in that moment, somehow hiding out in Alaska made sense to me. So in my mind, I was like, that's what I'm going to do. I don't see any other way out of this. So I marched up to my wife and I was going to tell her we're going to take, you, me, and the two kids, and we're going to go hide out in Alaska. And I walked up to her and I was just about to say it and couldn't get the words out of my mouth. So I went in the bathroom, took a shower, threw myself a little pity party and cried some tears. And, I went back to what my family did. I went back to work, and you work hard. And I found a consultant and he helped me realize that I needed to focus on my numbers and start being a businessman and start focusing on not just working hard, but understanding what profitability was, what it is, what gross profit margins were, how to price things, what markup and margin really were, and why I needed to really focus on the numbers in my business. And I was really doing myself and my family a disservice by just, focusing on what dump truck I had, what color my mowers were, and just the work hard and work a lot was only going to get me so far. It really couldn't get me much further than where I was in a hole. So the next few years, I read as much as I could. I studied as much as I could. I visited people. And over the next 20 years, I became really just obsessed with business financials, how to read balance sheets, how to read P&Ls. Um, and I visited over 50 businesses all across America, landscape businesses, successful landscape businesses. And each business visit, I would take something away and we would look at their balance sheets, and we wouldn't go outside and see the dump trucks and the Z sprays and the mowers. We would look at the balance sheets and the P&Ls and really see what was healthy and good about the business and what was struggling in the business. So I got to learn quite a bit about people. In each one of the visits, it was a story about a struggle and a success. Like no one who is successful in business didn't come through a struggle, or maybe one, two, or three struggles, whether it was divorce, depression, almost bankruptcy. Like there's no easy road in this industry. No one just walks down some yellow brick road to success. And that really encouraged me to, continue forward with my journey of like learning and keep my head down and keep moving forward. It took me about 7 years to pay off that $250,000 in debt. And, it wasn't easy. Sometimes me and my wife went without a paycheck for 2 or 3 weeks, but we kept moving forward and we got there. And I did end up growing a very successful and profitable business. But the stories that people shared with me about their businesses really encouraged me. You know, once I learned this, I was like, hey, I want to help other people in the lawn care and landscape business. So that's what I do a lot of that now. My business, I don't work in my business day to day anymore. I have a partner, Christine Era. She has an accounting business in Colorado. I got really involved in Profit First. It's a process, it's a cash flow management system where you pay, the owner gets paid first, you take your profit first, the company gets their profit first, and then the money gets managed in a very intentional way. You know, the money gets moved through the business, whether we're managing it or not. But Profit First is just a really intentional way of moving the money through the business. So she helped me, and it was so impactful to my business. The business grew, it doubled, and then grew another 50%. And it was so effortless in that growth and so stressless that I was like, Christine, you know, we got to get this out to the rest of the green industry. So let's write a book. I put the money up for the book, and she did the heavy lifting. Honestly, she wrote the book. She's an accountant. It's Profit First Lawn Care and Landscape Businesses. It's really an accounting book with some lawn care and landscape businesses and stories of, you know, friends of mine and other people in the lawn care and landscape business, and how managing their money helped their business, but also their quality of life. And that's really what we're in this for. You know, we're not in this to buy Ferraris and Lambos and all that. Maybe some people are, but the majority of us in this industry are not. We're doing it for our families. So the Profit First and all of the work that we do is really to help people, because this is a hard way to make a hard living. Typically, this is not easy street, right? So that's kind of why I'm here today. Joe asked me to do this. I'm doing this, you know, for the industry, like many people who are involved in the industry. I know Peter House is here. You know, he volunteers endless hours for CNLA and the CNLA Foundation. Many people in CNLA, Connecticut groundskeepers, you know, these people are donating countless hours of volunteerism because they like the industry, but they care about the people who are in the industry. And that's another reason why I like this industry, because it's just full of people who are who just care so much about other people. So I'm going to do a PowerPoint, and it's just really to give you some background about, you know, how to pay attention to your numbers, kind of what to pay attention to in pricing. Because one of the things I really found was in all contracting, not just lawn care and landscape, how to really make money is your pricing and how to estimate. You have to, but to estimate correctly, you have to have the right pricing. So if our pricing is right, then we can estimate correctly. But if our pricing is not right, nothing else matters, right? So it didn't really matter what color our mowers were. You know, I know Facebook, we love these wars. You know, red, yellow, green, orange, you know, is always the best mower. Which truck, Ford, Dodge, Chevy, none of that matters. If your pricing is not right and your estimating is incorrect, you cannot make money, right? So regardless of what you do, having that pricing right and then doing your estimating correctly in all contracting is the best and easiest way to make money. So we're going to start with pricing today, and I'm going to kind of give you the longhand math version. I'm going to give you the cheat version, some easier numbers to use. I love price sheets. I love cheat sheets because nobody has time to go through long calculations during the middle of the season. So we want to have those calculations done ahead of time, and then we can use our cheat sheets. So I'm going to figure out how to share my screen, and we'll start my PowerPoint. You should be seeing a full screen. All right. Joe, if you're not seeing a full screen, you can let me know.
Looking good, Steve. Oh,
Yep,
you got it, Joe.
Awesome. Thank you, Sam. All right. So 5 steps to ensure profitability in your lawn care and landscape business. I'm Steve Bousquet. I don't know what's up in my throat. Hold on one second. And this is Christine Era. She's my partner in Green Profit Academy. She's the accountant. She's the one that pays attention to all the details. So the objectives of this webinar today is to understand your cost, analyze your competition, determine your pricing strategies, set profitable markups and margins, and then talk about regularly reviewing and adjusting prices. In the regularly reviewing and adjusting prices since COVID is just really, that is so important because so much has changed since COVID with prices, right? And then, so first understanding cost, direct cost, and then indirect cost. So we'll talk about direct cost and indirect cost. And then, so if you don't understand everything, you know, you can contact me. I'll love to go over this later. And some of you are going to be like, I've heard this stuff 100 times. And so bear with me. So direct cost is anything that is attributed to the cost of doing the job, right? So let's say we're going to do a landscape job. So the soil, the mulch, the plants, the labor, the trucks that are there, the excavator that is there, the skid steer. So anything that is at that job site or the material that is going into that job to produce the revenue tied to that job. Or if you're mowing, right, the lawn mowers that are at that job, the truck that is at that job, the labor that is at that job, that is a direct cost. So anything that is specifically tied to generating revenue is a direct cost. So in fertilizer, if we're doing, grub applications, right, that grub be gone. That is a direct cost. That material, the labor's direct cost, the equipment that is at that site producing that revenue is a direct cost. Costs that are not tied directly to producing revenue are indirect costs, right? So the office staff, the shop, that's indirect cost. Insurance, telephones, anything that is not directly related to producing that revenue is an indirect cost. So we want to calculate each job's cost. And this is earlier I was talking about doing this stuff ahead of time. And, we want to do this way ahead of time. So on each type of job, and most of us are going to have either divisions or departments, or we're going to be doing, the same type of work over and over again. So we want to identify each type. So maybe you have a mowing department or division, a landscape, hardscape, lawn applications, maybe it's mulching, pruning, gardening, but you want to have really a direct cost and an indirect cost for each one of those types of services that you're providing. You want to get it as close as you can. It doesn't have to be perfect, but you want to have identified direct costs that go into that. It's easier when you're doing materials and also with equipment, right? And then labor. So each job type is going to have labor, materials, it's going to have equipment, and it's going to have vehicles, right? So when you look at a landscape job, you're going to have like materials, you're going to have the labor, you're going to have your type of excavator, skid steers, or mini skids, then you're going to have your trucks. Depending on the size of the truck, a pickup truck for a lawn mowing crew is going to cost a lot less than if you have big dump trucks for a landscape crew. So you want to, all those are direct costs to that job. So you want to identify that. And then you want to calculate what those direct costs are by summing up all that labor, material, and equipment usage. And it can be shocking, actually, how much stuff costs. So, but knowing what that is and doing that ahead of time is what you want to do. And it can be daunting to do it. So sometimes having a partner or having someone to work that, whether it's your accountant, your business manager, your office manager, a coach, but going through that, this is where you can make money. And that's why I was saying earlier, you can make more money spending 4 hours doing this than you can working on a piece of equipment, working out in the field. And what's really valuable about this is it's an annuity. So you can spend 4 or 5 hours working on this. It pays for 20 or 30 years. So the return on the 4 or 5 or 6 hours you're going to spend on this It's for years, and you could be talking $500,000 to $1 million or more return on that. So it's pretty valuable to spend some time on this. So determining indirect costs, right? Expenses that support the entire operation but are not directly linked to a specific job. So office, phone, insurances, basically another word for overhead, right? So expenses that are not related to that. So it could be also marketing, like social media, websites, anything that's not related to a very specific job. But we need to allocate indirect costs to jobs, right? So for example, like the biggest part of my business is the application business, right? So I do allocate my marketing. So most of my marketing is allocated to my application business. So that is an indirect job cost, but that expense will get allocated to that. And we have a full-time bookkeeper, and 80% of her time is spent to that. So for the applications, so her 80% of her time gets allocated towards the application side. And then we want to calculate each job's total cost. So we want to do that. Now, this is not a 15-minute thing. We'll spend multiple hours on this. But like I said, this might be some of the most valuable time spent because it pays over and over and over again to know what our costs are. So then we can charge the right amount. And every time we go to do an estimate, we know the numbers are right. And how do we know our numbers are right or they're not right? We know they're not right in the long term. We don't know it right away sometimes. We know it's not right in the long term, and it starts showing up when it's not enough, when we have too much month at the end of the money. We're having a hard time paying our bills. When we're paying our vendors a little slow. When we're trying to figure out how we're going to pay everybody at the end of the month. When we're really busy and we still are having a hard time paying our vendors, or when we're a little slow and we're having a hard time paying our vendors. And so one of the things with Profit First is how the money comes in. It all goes into one account. Then it gets allocated as a percentage into other accounts. So we have a vendor account. So as the money comes into the income account, once a week, it gets distributed out into a vendor account, a payroll account, owner's account, tax account, and then an OPEX account. So the money is always there for the vendors. It's always there for the taxes. It's always there for payroll. It's always there for the owner. And then if you're unable to fund those accounts properly, that's an indication that the pricing is not right. So when you're feeling those pinches and pains, that's usually when you know the pricing is not right. So how to calculate each job's cost, right? We want to identify direct costs, labor, materials, equipment usage, and we want to calculate the direct cost. Example calculation in just, these are just examples, so don't use any of these numbers, but $200 for labor, $150 for material, equipment usage. Then you have the total cost. You have to determine your indirect costs, administrative expenses, like I was sharing earlier with the bookkeeper, marketing expenses, utilities, and you want to take the total indirect cost and then allocate that indirect cost to jobs. You can either do it monthly, you can do it job shared based by percentage of hours, and you want to allocate that indirect cost. And that gets you to the calculating the total job cost. So direct cost was 400, indirect cost was 100, total job cost was 500. So this is just an example of like taking time. And this is just for an example, but this just gives you an example. All right, strategies to monitor calculating cost tracking. So if we're not tracking any costs, sometimes we don't know that the costs are going up. And, I've been guilty of this before, not really just assuming that prices were staying the same. We saw on plant material, we've seen it on block and aggregate, where we call it creep, right? it's only going up about 2, 3, 4, 5%, and then you don't track it. And then 3 years later, you're short on your estimates, your estimated versus actual, you're off. And you're like, what's going on? Are we using too much material? In reality, it was that we weren't adjusting our prices annually, and it was called creep. So tracking cost is really, really important. And that can be done. We try to do it annually, and it really should be done quarterly. So, we definitely do it annually now, and we are trying to do it semi-annually now. So we moved it to, after COVID, we moved it definitely to semi-annually. And for the lawn application, we do it by round. So we're tracking it every round 1, 2, 3, and 4, and 5. So we're tracking those by round. But for aggregate and block, we're doing it semi-annual now for the landscape. And then monitoring external factors. So paying attention to what's going on in the world, especially now. There's a lot of changes, and that could be week to week now. So we're really paying attention to the news, to prices, to what external factors are going on that could really affect our prices, and how quickly they could change. So, and that is, COVID really taught us a lesson on prices. And also there's political things that could happen that could change and affect prices. So we just want to be aware and ready for that. And we don't want to be caught off guard for that. Supplier relationships, also being aware of that. One of my vendors sends emails out about what to expect as far as like upcoming prices for fertilizer or upcoming prices for different materials, some of the mixing material that went into some of the chemicals, I guess, was going up. So to be aware of that. So if we're going to give prices, so, we send out prepay letters for they can pay the whole year in advance. So if people are going to pay us a whole year in advance, that we need to know what that pricing for the materials are going to be, because if we're not going to buy the whole year in advance, we need to know. We don't want to get caught off guard for that. And then also having a flexible pricing strategy. So be ready to adjust prices, implementing like maybe fuel surcharges, or making sure that we don't get caught off guard too much. So, and we have to really watch that, offering that that prepay for the year, because if fuel goes from 369 up to, well, I remember COVID, it went to 609. We had to calculate how much was that going to affect our total spend on diesel if it stayed at 609. So, it could be up to $4,000 to $5,000 a month. So it could be a $40,000 swing. And fortunately, the diesel prices came back down after a month, but it could have been a huge impact on our company. So you definitely want to pay attention to that. We did not have to implement any kind of pricing strategy, but we did in our contracts allow for that language in there to say, look, if this spikes, we are able to have some flexibility in that. Efficiency measures. So looking at ways to become more efficient in the company. So either using routing, we like to use routing efficiencies. There's black box routing. You can use AI for routing, but also like crew sizes is a big issue. Like too many people on a crew, or crews, too many people, just waiting around and loading. Like, how can you load more efficiently? One of the biggest things I've seen in a lot of my visits is getting out in the morning and at night, loading trucks and everything. So a new thing in the industry now really is having the crew foreman. He's the guy that loads the truck in the morning. And then you'll see crew members, they get picked up out towards the front of the building. They're not in the back. And 2 or 3 crew members are not in the back helping the foreman. He's doing all the gassing, fueling, and loading, and then they go pick people up. And they're saving, an extra amount of 5 to 8% labor a year. And they're able to use that towards the profitability of the company and also to give raises to the employees. So looking at ways to increase efficiency in the company. Forecasting and budgeting, that is, using historical data and having contingency funds. So part of the Profit First program is having what's called a vault. So at the end of each quarter, you take your profit fund, and a portion of that profit fund goes into what's called the profit vault, and that is a rainy day fund to have a portion of your reserves for a what if day. And if it's not really a matter of if it's going to happen, it's really when it's going to happen. So making sure that you have some money set aside for when that happens, but also having some forecasting. And you can use tools. You can actually use your Profit First tools to budget. If your sales are going to be 5% higher, 5% lower, 10% higher, 10% lower, what does your budget and percentages look like? And because in the Profit First model, everything is based on percentages, everything rolls out based on that percentage. So it's much easier to make the adjustments. It's not finite dollars, it's percentages. And then finally, customer communication, maintaining real clear transparency with the customers and just letting them know what costs are. Most people are aware that, when eggs are whatever they are now, 8 something a dozen, or they're aware that prices have gone up, and just communicate with them. And that the other thing with cost, if you're only selling, or if we're only selling on cost, it means that we really have to look back at ourselves and say, what else can we sell on? Can we sell on based on our mission, based on our purpose, based on our value? Or are we only a price? Are we Walmart? Is that what we're the only value we bring? So another one is we want to analyze competition and survey the competition to understand what the market rates are, and we want to then compare our value proposition. So, and it's not really to be the lowest, because the race to the bottom, almost no one goes out of business from being the most expensive or in the top end. Being the lowest, cheapest in the market almost guarantees the struggle. And you hear it all the time. Nobody can understand how they can be that cheap. And usually it's hard to stay in business being the cheapest. It's almost impossible. So you definitely want to do a survey and see who else is in your market. And then what's the value proposition that you can offer, and not just on price, but what do people really want? They want trustworthy, they want communication, they want a good value, they want knowledgeable people. I know in my company, my clients love communication. They like the fact that the same people show up at their house all the time. They like that they can talk to the same people in the office over and over again. They like that consistency. They like that we're from this area, that we're not corporate. We're not located in, we're not from Tennessee. We're not corporate. They like those types of things. So we lean into that, right? We're not fighting. We're not fighting the dollar. They like our mission. They like our purpose. So that's what we're dealing with. And people who get that get us, and we get them. And people who are going for the value proposition of low price, they can find a vendor for that, and they appreciate that vendor. All right, so competitive strategies. Survey competitors. You can survey the competitors and see where you want to fit in on that. So the psychology of economics have found that people get a kind of a dopamine rush in 2 ends of the economic scale. One is when they get a really good deal, like a bargain, they love to share that news. And then when they buy stuff at the high end, so they love to buy high end quality goods, they love to share that. So when they not overpay, but when they pay a higher amount and they feel like they got a really good value at that end, they share and they get a dopamine rush. Or if they get a really low end and they get a really good deal, they love that. So you got to survey where you want to be in that, and then analyze your service offerings, what you want to offer, and what levels you want to offer that at. And then like you look at your service comparisons, right? You want to have kind of a good, better, best. Not everybody wants the best. Some people want the middle, some people want the bottom, but at least offer that three, kind of like the gas station, right? You have three levels of gas. That's for a reason. When you go to the stores, you have different options, different sizes or different flavors. You want to give a little bit of an option for service prices because it actually would be difficult to serve all clients at the highest level sometimes. So, but some people really want to pay for that extra attention or the extra service. And then look at your pricing strategies, and that's where I get to that, good, better, best. Some people do want the best of the best all the time, and they don't even look below that. And other people, they're okay with the middle. They're fine with it. They don't need the best, the best. And some people, they just the basic is good for today. Maybe they'll try the best of the best another day. But that's one of the things that we can do as contractors is we don't know what's in their bank account. We don't know what's in their checking account. So offering the three options instead of just one price where the only option is yes or no, right? Yes or no. That's it. And that's not really fair to them because now we're forcing them to go to another vendor or say yes. It's either yes or no, or it's not fair to us because we're like putting a lot of pressure on this relationship. It's either, yes or no, and it ends. It either goes on or ends. So giving options is really honoring that relationship in a safe way and giving them a chance so they don't have to get other prices because you just literally gave them other prices. I don't have to go get other prices. You just gave me other prices and having that pricing strategy right in front of them. And you can do that really by highlighting the value, right? Highlighting the value proposition, highlighting what is included in that pricing strategy. And that is kind of our job. And that's like the local, the highlighting your vision, mission, purpose, like what is that about? How can they connect to it? And if it's just only price, that if that's the only thing you're connecting to, then that's really hard to compete with. But if you're sharing your mission, if you're sharing your purpose, that's a whole nother opportunity for people to connect with you and your community and your company. Like, what's the mission of the company? What's the purpose of the company? And it gives them another way to connect. And then they can also share, your story, your mission story, and they can feel much better about it because people have the money, especially in the markets that we're operating in. They want it, but they also want to feel good about how they spend their money. It's not about just a dollar. They want to feel good about it, and they want to have a story that they can share with their family and friends about what they're doing, especially the yards. Remember that if we're working in people's yards, like my main market is residential, so we're working in their most intimate space. This is where their kids play, their grandchildren play, their dogs, their cats, their pets are there. They're there. They're inviting their closest friends, the most important people in their lives are at their house. So, the mission and purpose of like everything that happens there is so important to them. So if they can have a story about who's taking care of their yard and why it's so important, that is really important to these people. It's important to us, right? That's why we're doing it. It's very, very important. So we want to avoid price wars. No one benefits from that. The customer might benefit today in the moment, but long term, it ends up they have to get a new vendor. It's very risky for clients to get new vendors. They have to do the whole thing over again. And when clients hire people, whether it's commercial or residential, they're taking a risk, taking a chance on hiring someone, a new vendor, and that can be risky. They also are answering to someone. So they have to answer to the husband has to answer the wife, or the wife has to answer the husband, or somebody is answering to someone. So it's easier for them to stay with the same vendor and get the good results and have the communication than to be always getting a new contract or a new person and then having to re-explain everything to everybody. And then educate your customers. And that is like, how do we do that like in a really safe way? So I have been like me and Joe will geek out on talking about microorganisms and soil, and we want to do it in a way that the customer can understand. So we want to use a lot of graphics. We want to use a lot of photos. We want to use a lot of terminology that they can understand. My staff is better at it than I am because they're not using, I'm talking about the molecular weight of a calcium molecule and the atomic weight, I mean, and it's 40 and, and my customers don't care about that. And so, use language and photos that the customers really can connect to, but use stories about why you're in the industry and why you care so much about doing the right thing in their yard. That's what people care about. So it's interesting. And I don't really like PowerPoints because of the, click, 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 but people remember stories. They don't remember, PowerPoints. And that's why movies are stories. They're not PowerPoints. So, share stories with our customers. That's what they remember. That's what connects to them. And that's why books are written in stories. And that's why, our books at school are so boring and hard to read because they're not stories. They're so difficult. So use stories to educate customers. All right, there's different ways we can charge. All right, I got time. Yeah, hourly rates. You got project-based, value-based. Hourly rates, time required can be. So we want to use hourly rates when times can vary significantly and we don't know how much. We used to do leaf cleanups. We used hourly rates because it could be different from year to year, whether the leaves were really dry or really wet. Payment for every hour worked, clear link cost between revenue. You can do project-based, which I think, most people use for landscape installation, have a really clear scope and predictable resources, simplify billing and budgeting, clear expectations up front, and then value-based pricing. So services delivered significant value, distinct competitive advantage or expertise, maximize profits by aligning prices with perceived value. So the value-based pricing is really for the organics and the lawn care. There's a lot of perceived value around people that know how to properly apply and when to apply, because there were some good questions about the grub control. When do I apply it? How do I apply? 2 pounds per thousand, right? When do I apply it? So the ability to apply 2 pounds of material over 1,000 feet is a skill set, right? And my team, we're always practicing and measuring and weighing and repracticing and calculating, and like calculating the equipment is a daily, like actually hourly by hourly, like paying attention to how much product we use at every single property. It's like property by property, constantly monitoring that. And that's a skill to put 2 pounds of material or 4 pounds of material over 1,000 square feet and do that over 200,000 square feet. So that's a value-based pricing. So, and it's technical. So, when we're pricing lawn care, especially these types of applications, we want to make sure that we're putting that value on that, and we're not just looking at it like lawn mowing. And I'm not saying lawn mowing is not value priced because, and right, when you see a lawn that is mowed by somebody with skills, it is gorgeous. The lines are striped, the lawn is edged, it's gorgeous. And when you see a hack job, you can tell the difference. So big difference. But that guy who can stripe a lawn and make it look gorgeous, he needs to add that value-based pricing on that. So you have pricing models. You have cost plus pricing. Basically taking what it costs, labor, material, equipment, trucks, and then adding your markup on that. Tier pricing catered to different segments of the market. Subscription models, kind of like Netflix and Apple and all that stuff, reoccurring services, charge and value-based pricing, charge a premium for the services. And that's really what the lawn care, especially the organics, is. And then straight forward versus flat rate, hourly versus project-based. So I want to really focus on that value-based pricing because that's what, for the organics and the lawn care application, that's really what we're doing. It's value priced because not only are you doing those applications, you have to know, is it sun, shade, what's the turf type, right? Is it irrigated, not irrigated? How much irrigation? What's the soil type? Is it soil, is it sandy loam? Is it clay? What's going on with this lawn, right? Is it all bluegrass? Is it a mix? Is it tall fescue? Is it fine fescue? Is it blue rye, blend? What do we have here? So there's a lot more going on than just, running even 2 pounds of whatever or 4 pounds of whichever product over the lawn that you are doing. What's the age of the lawn? There's so much that goes into that. So I would really recommend focusing on that value-based pricing. All right. I got 15 minutes. So set profitable markups and margins. A markup is a percentage added to cost to achieve a desired profit. So markup is, so something costs $100 and we're going to mark it up. So basically we're going to mark it up to $200, right? So we marked it up, we doubled it. So what margin would that give us? If we go from 100 to 200, well, that's a 50% margin, and we're going to do the math. So knowing our margins are really important, because after we know our margin percentage, that's the percentages that everything else comes out of. You don't have to remember all this. This is just the points I'm going over. So a comparative importance, markup versus margin. So markup ensures that the price covers the cost of what we pay for. And the cost could be labor, it could be the truck, it could be the equipment, it could be the material. So we always have to remember thinking like, we have all these costs in our business, and sometimes they feel invisible. Even if the truck is paid for, the truck cost, right? We got maintenance, we got registration, we got insurance, repairs, tires, tax. So there's a lot of cost that goes on, even if that equipment has already been, supposedly the payments are paid for. So markup is ensuring that the price covers the cost plus a profit percentage. And we want to make sure that we're getting paid for our investment in that equipment. And it is an investment. We would never put money in a bank and say, don't give me any interest. And as a matter of fact, not only don't give me any interest, depreciate that money over 5 years back to zero for me. Because if we're not getting a return on our equipment, we're actually depreciating that equipment down to zero. Because that's what equipment does. And then margin is essential for evaluating the selling price, profitability, and determining profit margins after costs, covering the costs. So markup, you don't have to remember this. I'm just going to go over this quickly. Then I'll give you the cheat codes. So something costs us $75. The markup, the revenue gets to $185. We have $110 in profit. So we're going to figure out what our margin is on this. So if we have a $75 cost and we're going to sell it for $185, we get $110 in profit. That's pretty nice, right? So we have 146% markup. So what's the margin? So if we do the margin, so with $185 revenue, cost of 75, our profit is 110 with the markup. So we do our math, 110 divided by the revenue of 185, that gives us 0.59% times 100% to give us a percentage. So we end up with a 60% margin. So where does that margin go to work? So on our P&L, we end up with a 60% margin. Now, remember all those indirect costs that we talked about earlier? All those indirect costs come out of that. So all of the indirect costs now all the overhead comes out of that. Profit comes out of that. So it all comes out of that. So if we don't have a high enough markup, we don't have a high enough gross profit margin, we don't have a high enough net, and we don't have enough money to pay everything else. So that's why it's important to figure out and calculate your gross profit margin. So regularly review and adjust your prices, assess your prices, solicit feedback, and you can feel the feedback sometimes when money's tight. Continuous evaluation, schedule regular pricing reviews. Like I said, we moved ours up from annually to semi-annually for certain products, and we do it for every round for lawn care. Monitor cost fluctuations. Right now, I would definitely, keep your head on a swivel for that. Track market trends, implement feedback mechanisms, analyze feedback for insights, and communicate changes. So with your customers and your vendors, you want to definitely be talking with them. All right, I'm going to stop the share. So let me, can I put this in chat? All right, I put a calculator that everyone can have in chat. So I'm going to share the cheat codes for the margins. Back in the day when I first started, it used to be very popular for people to take like any material, especially in the if you're doing landscape installs, it would triple it, and you would charge for that. So if it was like,
Hey, excuse me, Steve. Just
yeah,
wanted to tell you that that link you sent, if you could just send it, you sent it in the general chat, just send it. Make sure it's sent to everyone because it just sent to us. So there's an option to send to everyone because it's just sent to the host and panelists right now.
all right, let's see.
Let me know if you find it.
I'm not seeing a option for that.
If you hit two, it should show everyone or it doesn't. I could also send it.
Okay,
That's fine. Go ahead.
all right. So when I first started 40 years ago, one of the cheats was, okay, if a tree's $100, you multiply it times three, you charge 300. But now, really, what we want to do, because we're more sophisticated now, we have these wonderful, phones and everything. So really, we want to mark up our labor, we want to mark up our material, our equipment that we're using, and our vehicles, our trucks. So if we have our labor, we want to mark that up, and we want to mark up the equipment, and we want to mark up our material and our trucks, because everything is so much more expensive. And that really was not doing us any service, marking up the plant material by three, because they're mutually exclusive. The material and the labor don't have anything to do with each other. So that was really, really bad advice. And that got a lot of people in trouble. So basically, if you want to have a 50% gross profit margin, you're going to mark up everything by two. So if the guy's costing you, if you're paying a guy, and here I'll give you some real quick math. If you're paying a guy $20 an hour, and there's a 27% labor burden, which is average in the industry, and the labor burden is workers' comp, unemployment insurance. You have to match his Social Security. Then you have the days paid off. So that ends up being 27%. So it ends up being $5.40 if you're paying $20. So it's costing you $25.40. So if you want a 50% gross profit margin and you're paying them $20, you need to charge $51. If you want a 65% gross profit margin on a $20 an hour employee, it's $73 an hour you have to charge. And if you want, so that's in that range, you can go between 50 and 65%. So 51 for 50% and 73, that's just for the guy, that's not for the equipment. Now, if you want for the equipment, you have to charge again. So on average, it's going to cost you about $10 for a truck, not including the gas. So you're going to have to charge for the truck. So that's about $10 an hour. So you have to charge for the truck. And then it's another $10 on average for the equipment. But we want a return on our equipment, just like we want a return on our money in the bank. So if you want a 50% return on your truck, 50% gross profit margin, that's $20 an hour. And if you want a 50% return on your equipment, that's $20 an hour. So you're at $51 an hour for the guy. This is at 50% gross profit margin, $20 for the truck, $20 for the equipment. So you're at $91 an hour. That will give you a 50% gross profit margin. That's a little reality of how much that you would need to charge. And once you go below 40% gross profit margin, I call it the smoke alarm, because once you go below that, and you pay all your overhead, there's almost no money left for profit. All right, we can take questions.
Hey, okay. Great job, Steve. That's really, really helpful. I think, being a scientist and coming into this business, I spent 5 or 7 years making every mistake and learn more from the mistakes. Fortunately, like your business, we were able to make it through. Even I do something different than all the landscapers out there. And I always say, pricing and profits is really more of an art than a science. And I think, your books and your advice certainly help to get it closer to a science than an art. And but it still is, how do you go too high and lose clients? You go too low, lose money. So it's always a balance. So let me see if there's any questions here. I'll open up the Q&A. As a reminder, Steve's going to stick around. I'm speaking next. Steve will stick around. I'll stick around. Vin will come on. And during the lunch break from 12:15 to 1, we'll have a open Q&A session if everybody has questions. Let me see. Umar asked, the fixed cost would be per dollar above the $90 per hour?
So the fixed cost would be in that $90. So the markup would cover the fixed cost on average.
Thanks, Steve. Art Carone asked, we add in replacement costs for all equipment for our calculations. Do you?
We don't. We will capture that in the markup. Yeah, we don't.
Okay. And Art also asked, do you have 3 book recommendations besides yours that you would recommend for this industry?
So the other books I would recommend are Simple Numbers by Greg Crabtree. Simple Numbers, Big Profits. And then I can post them in the chat during your talk, or I'll look them up. Accounting for the Number Phobic is a great book. Yep. And I can't remember the woman who wrote it, but that really helped me. So how I kind of went when I started my journey was Accounting for the Number Phobic, Simple Numbers by Greg Crabtree. Then I read Profit First, the original Profit First by Mike Michalowicz.
All right. And where can people get your book? I know Steve really does this because he likes helping people, and I can vouch for that. He's not in it for the money, but your book is great. Where can people get the book if they want it?
It's on Amazon.
Okay.
And we also have a podcast. I'll post some of that information during chat. Right now, for some reason, I can only post in host and panelist.
Yeah.
But once I get at it, I can post in the other one. So we have a podcast, Green Profit Academy Pros Podcast. It's on Apple and Spotify. And it's mostly towards the green industry, but it has a lot of information. So Green Profit Academy Pros Podcast. And we passed our 100th podcast a couple weeks ago, but that's pretty good. We offer a lot of free tools. If you go to greenprofitacademy.com, we have a whole free toolbox really made up just for the green industry.
All right, great. Yeah, and Steve's word's gold. We we both made mistakes. You learn from the mistakes, and he's been very successful. So it's really helpful. This is the tough part, is running the business. Most of us aren't trained in it like you, and we just sort of have to learn on the fly. So that was great, Steve. Really appreciate it. And again,